Well, what I said then is what I always say is that we have three strategies, but in the conservative fixed income strategy, almost everything we own in there we own is less than 60-month maturity. Okay, and if you're going to own that as a currency hedge, because we feel like long term the dollar will continue to decline. If you're going to own the fixed income, you have to us, you've got to own some bullion, some gold bullion to offset it. And that's what will offset it. And it's a different time now. I know people want to think about it, but most of these major countries are lining up against us, not for us.
When gold pulls back, it often sets the stage for the next powerful surge in price. Ted Oakley, a seasoned investment advisor, emphasizes that while a dollar is always a dollar, the real issue is the price you pay for it. Buying at a discount makes sense, but overpaying leaves investors exposed, much like today's overheated markets. He draws a similar parallel to gold, cautioning that a correction into the $3,100 to $3,300 range should not be mistaken for the end of the bull run. Instead, he believes such pullbacks are part of a larger cycle, with the coming decade likely to be defined by rising commodities and inflation. In that environment, he argues, gold miners still have the potential to double or even triple in value. He further explains that this is not business as usual but a new era in global finance. Nations such as Russia, China, India, and several in South America are steadily shifting away from U.S. Treasuries and into gold, seeking something tangible rather than exposure to increasingly fragile currencies. With confidence eroding in the euro, pound, yen, and even the dollar, Oakley stresses that owning bullion has become an essential hedge in today's uncertain world. Reflecting on recent price action, Oakley notes that when gold broke through the $3,400 to $3,500 level, many assumed the rally was over. Yet instead of collapsing, the metal merely moved sideways, proving its resilience in a time of global turmoil. This, he argues, is a sign that gold ownership will only grow as instability deepens. He also points out that despite their recent rebound, gold miners remain significantly undervalued. If current cash flow levels were valued at the same multiples as in past cycles, those stocks would be poised to deliver gains of 2 to 3 times their present levels. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Well, I know people get to thinking about that, but a dollar is still a dollar. And if you get a dollar, if you buy a dollar for 80 cents, that still makes sense. And if you pay $1.20 for a dollar, that doesn't make sense. That's sort of where you are in the markets today. And I guess where I would disagree with people on the bearish side is you can have a safety net of 35, 40% treasuries or whatever. That doesn't mean you're not participating, okay?
Right.
It just means you're particular about what you're doing, and you're not going to go all in and basically put risk fully on when you know things are at extreme price levels. And I mean really, really extreme. So it's not necessarily, you're not making an absolute 100% call. I'm completely out or I'm completely in. I just think you have to pick and choose and know what you own. And I believe people, that's where they've gotten confused. They felt like they had to be all in the market. I would have missed the market. Well, you wouldn't have. I mean, if you had 2/3 of your money in the market, you wouldn't have missed the market, okay? But you would also have given yourself a little sleep at night, because if something goes wrong, you have some liquidity. Well, what I said then is what I always say is that we have three strategies, but in the conservative fixed income strategy, almost everything we own in there we own is less than 60-month maturity, okay? And if you're going to own that as a currency hedge, because we feel like long term the dollar will continue to decline. If you're going to own the fixed income, you have to us, you've got to own some bullion, some gold bullion to offset it. And that's what will offset it. And it's a different time now. I know people want to think about it, but most of these major countries are lining up against us, not for us. Look at Russia, China, India, to an extent, some of the South American countries. And they're buying gold. They're not turning their dollars around and trying to buy back into the assets of this country, particularly Treasuries.
Yeah.
They want to own something. Like even a lot of them against their own currencies are doing that. So I think you have to own it as a hedge like that. We're in a different era, a different time when probably a lot of currencies. Look at the sterling, pound sterling. You look at the euro, yen. You can't have faith in a lot of these, including the dollar. And I think that's why more of them side by side, they own the gold bullion. And that's what I think people have to keep in mind. Well, we own a number of miners. Now in our stock account, we only own the royalty companies like Franco-Nevada,
Right.
Royal Gold, Wheaton. But in a high income account, which is sort of a commodity offset account, pays a lot of cash flow. We own the direct miners. I mean, we own Agnico and like I mentioned before, a little company, New Gold, but we have also in there, we own Royal Gold, Wheaton. But I think people have to remember, and I think this will bother them probably, but if you get a correction in gold, and let's just say you went down to 33,000 or 3,100, I think people would think it's over and it's done or whatever. It's probably not because of the way the world's set up this next decade. Especially, we feel like commodities and inflation are coming back. That's going to be a new world order. And if that's the case, you don't want to get shaken out on a downturn like that because you could very well get it. But for new money, yeah, we still buy them. We may not buy quite as high a position as we would have a year ago or a year and a half ago, but we still own the same ones, yes. I don't know. I think it confused a lot of people, Jeremy, when it went through 34 or 3,500.
Yeah.
They thought that was it. And you can't ever tell till afterwards, but it really didn't. It kind of drifted sideways for quite a while. But, there's just a lot of reasons why, with all of the turmoil that's in the world, I think that gold will become more owned. See, people like, it's not a very highly owned asset. You look at the miners, virtually nobody owns them. I mean, they're, you're looking at gold and gold miners. They've been one of the best groups, maybe the best group this year. But yet you're not going to hear it on Bloomberg or CNBC. I hear it from you. They're very profitable, though. If you go in and look at today's numbers, I'll just give you this example. And I used this graph in a presentation last week. I said, let's just take the GDX, which is the large gold miners, okay? We have just now equaled the price of the GDX as to what it was in 2011. That's 14 years ago. I mean, we're just now even. We're not breaking in the new highs yet, and you're not even close on the junior miners.
Yeah, no kidding.
And so while they've had a move, they have to realize how cheap they were. And if you look at the cash flow numbers now on gold miners, if you were to sell those same multiples of that cash flow as you had in 2011, those stocks would double or triple from here.
Beyond gold, Ted Oakley highlights the importance of silver, both through bullion and Pan-American silver. While he views gold as the more stable asset, he notes that silver has the potential to outperform because, when it moves, it does so with greater speed and strength. In his firm's high-income portfolio, gold and silver are structured together, offering a balance between stability and growth potential. Alongside these investment strategies, Oakley also stresses the personal side of financial discipline, warning that heavy debt is a major barrier to building wealth. Even modest savings, if invested at steady returns, can grow significantly over time, but only if individuals first eliminate debt and regain a healthy respect for financial prudence. When it comes to markets, Oakley avoids precise predictions but acknowledges that a 10 to 15% sell-off in the near term wouldn't be surprising. In such downturns, gold and miners are not immune, as seen in 2008, yet history shows their resilience. By late 2009, miners had already reached new highs and continued soaring into 2011. He points out that during sharp sell-offs, nearly everything gets liquidated except short-term treasuries, but these setbacks don't alter the long-term case for precious metals. Looking ahead 2 to 3 years, Oakley believes gold, silver, and miners will all be higher, making temporary corrections more of an opportunity than the end of the trend. Let's get back to the interview.
Well, they probably do. You have to be good at that area, though.
Yeah,
And
yeah.
I think people that do well in the junior minors, that's what they do. That's not what we do, and we're not good enough to do that. So if you're not good enough, then you don't need to be in there, because there's a lot of things going. I think there'll be a lot of merger acquisition in that area, though, and probably do some really good. I mean, and then we own silver bullion too, and we own Pan American silver. But see, it will really outstrip gold someday. Well, we only own one miner. We own Pan American, because but it's, again, it fits what we do. On the bullion, we own it. We don't own as much as we own in gold, because it's more volatile, and it's not as, I don't know how to explain it, but to us, it's not as stable as gold is. But when it really moves, it moves much faster and stronger than gold does. But we own them together, really, in particular in our high income portfolio, and that's how that's structured together. But yeah, I think you can own a little bit of silver too. If you are debt laden, you're never going to get ahead. I mean, you have to figure out some way to really save more than you're spending. And have some left over. And I think a lot of young people right now are just living for the moment. They're living for the experience, this, that, and the other. But that doesn't do them any good for the long run. If I sit down with them and say, hey, if you'll put X amount of money aside, let me show you what that would do. And use a nominal number, 6-7%, and it'll surprise them at how much money they would have. But they have to get out of debt first, and they haven't been afraid of debt. And I think that's the first thing they have to do. Well, I think too, what I say in the book is more about parenting, and if you have a lot of wealth, don't bestow that on your children. Let those kids have to go out and earn it the hard way, and then they'll appreciate money. I always say you can't appreciate money if you've never experienced having the lack of money. Like if I show up and I'm, which I don't agree with this, but a lot of financial people, financial planners and stuff, they want to bring them in at 16, 17, 18 years old and say, look, here's how we manage the family wealth, blah, 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 blah. Well, you just took all their ambition away from them. You don't really want them to know that right now. I disagree with that concept. One of the things I always say is don't predict price and don't predict time. But I will say this to answer your question. I'm not trying to, if you look at it, it won't be surprising anywhere in here that at a minimum you get a 10 or 15% sell-off just as a situation where something goes wrong, or, these numbers keep coming in weaker and weaker, and people say, you got to remember now, these portfolio managers, when you get down into October, November, if they've got really decent numbers, they're going to put some lockdown on it because they know they've made their year already. Yeah. And so that's part of it too. But I wouldn't be surprised if we don't get kind of a short, it's kind of what I call a sobering up sell-off. Maybe not the end sell-off where you really have a big move down. I think that comes eventually, and it may come from a different, maybe it comes from 7,000 or something on the S&P. Yeah. But things gets expensive and they stay that way for a while, and then something changes that changes the whole situation, and then all of a sudden you go into what I call sort of more of a generational bear market kind of thing. Yeah. I don't think you're there in it right now, obviously. But, you have to remember people in this industry, our industry, there's a lot of them that have never been through inflation.
Yeah, no kidding.
I've had to manage through inflation. That's a different game, all right? And they've never had to manage through, downturns that go on and on and on. And they really hurt, and you just can't get ahead on them. Those are things they've never experienced. And so I feel like that's coming some point in time. And you're going to be able to see who knows how to weather that storm. Well, if you get a sell-off in the market, Jeremy, gold and gold miners are going to sell off too.
Yeah.
But I would tell you, it'd be like '08. They sold off in '08. By the time we got to the end of '09, they were a new high. And we started, and then they really soared all the way up to 2011. And so, they'll sell off. They're not immune. When the market sells off strong, the only thing that's not immune is the 90-day Treasury, in our opinion.
Yeah.
Okay. And people try to hedge it and do this, that, and the other, all sorts of things. But if you really, anything that's up is going to get sold. So they'll sell them. But I think if you looked out a couple of years from now, 2 or 3 years from now, gold will be higher, silver will be higher, miners will be higher, even if you had a correction.
Gold and silver remain central as currencies weaken, debts rise, and markets stretch to extremes. While short-term corrections can shake investors, history shows that downturns often set the stage for stronger advances, with miners capable of doubling or tripling as valuations catch up to cash flows. Silver, though more volatile, tends to outperform gold during powerful surges, making it a valuable complement in a portfolio. Balancing safety through treasuries while holding bullion and select miners offers both protection and opportunity in an uncertain global order. The long-term case for precious metals remains intact, even if the path forward includes sharp but temporary setbacks. Do gold and silver corrections create buying opportunities, or should investors wait for clearer signs of long-term momentum? Stay tuned. If you're interested in real, data-backed insights on the financial system, be sure to like and subscribe so you never miss our weekly updates. Thank you for your support, and we hope you enjoy the video.